We have all been there. You find a stock, you look at the chart, and you see a vertical line like this. Suddenly, you freeze. One voice in your head screams, "Am I buying a great company at a terrible price?" It's the classic investor's dilemma. You don't need luck, you need a system. Today, I will give you a roadmap to make your decision in seconds, with full confidence, based purely on data. First, look at the roadmap. Step 1 is the Moat check. In financial analysis, we grade this in 3 levels: wide, narrow, or none. But what does that actually mean? Imagine a medieval castle. The gold inside is the company's profit. The water surrounding the castle is the moat. It stops competitors from attacking and stealing that gold. Wide means more protection. Level 1, the wide moat. This is a fortress. The company has almost no serious competition for at least 10 or 20 years. Take ARM Holdings. Their architecture runs 99% of the world's smartphones. If a phone maker wanted to stop using ARM, they would have to redesign the entire industry from scratch. That is a wide moat. Level 2, the narrow moat. The company has an advantage, but the walls aren't impenetrable. Think of Uber. It has a massive network effect, but if Lyft lowers their price by 50%, customers might switch. The protection is there, but it's not infinite. Level 3, no moat. This is the danger zone. Think of American Airlines. Airlines sell a commodity, a seat on a plane. If American charges $500 for a flight, but another airline charges $400 for the exact same route, you switch instantly. There is no loyalty, only a race to the bottom on price. The rule: if the moat is none, stop. If it is wide or narrow, proceed to step 2, which is profit check. We ask a simple question: is the company actually making money? This splits our analysis into 2 completely different worlds. Path A, profitable. Companies like Broadcom or Microsoft, they print cash. Since they have earnings, we value them based on those earnings. For these stocks, you look at the price-to-earn ratio to be able to calculate PEG ratio if there is no dividends, or PEGI ratio in case of dividends. Path B, unprofitable. Companies like IONQ and Rocket Lab. They are burning cash to grow. So, for these stocks, we throw away PE ratio because there is no earnings yet. We value them based on price-to-sales ratio. Let's walk down Path A, profitable. Most beginners look at the PE ratio. They see a PE of 10 and think, cheap. They see a PE of 50 and think, expensive. That is wrong. A PE of 50 is actually cheap if the company is growing at 50% a year. So, let's fix this. We should use the PEG ratio. This takes the PE and divides it by the earnings per share CAGR. It levels the playing field. But what about dividends? If you are buying a stock like Coca-Cola, the growth might be slow, but they pay you cash. The standard PEG ratio punishes them. So, for dividend stocks, we use the PEGI ratio. We add the dividend yield into the growth number. It gives credit where credit is due. The rules: if the number is below 1, it is undervalued. If it is around 1.5, it is fair. We are still in the buy zone. But if it is above 2, it is expensive. And if it is above 3, it is overvalued. However, expensive does not mean stop just yet. Ferrari is always expensive for a reason. If the stock is expensive, it must pass one final test to justify the price, which is the gross margin. You only pay a premium price if you are getting an elite business. But here is the trick. Context is everything. You cannot compare a software company to a grocery store. You need to judge them by their sector. First, software. If it's a SaaS company like Adobe or Palantir, they sell code. It costs nothing to copy. We demand gross margins above 70% to buy. Second, hardware. If they build physical tech like Apple or Nvidia, they have factory costs. We demand margins above 40%. Third, commodities. If they sell oil, retail goods, or cars, it's a grind. We demand margins above 20%. So, if the stock is expensive, but it clears the hurdle, it is a premium asset. You have a green light to buy quality. If these ratios feel a bit overwhelming right now, don't worry. At the end of this video, we will take 2 real-world examples to make things easier. And by the way, it would be an honor to have you as a subscriber. Now, back to the roadmap. What about the high-growth disruptors, the companies changing the world but burning cash to do it? We need to go back to the fork. Path B, unprofitable. Since these companies have no earnings, PE is useless. Instead, we use the price-to-sales ratio. We are paying for revenue growth. If price-to-sales is under 10 for a high-growth tech stock, that is generally cheap. If it is around 20, it is fair, but priced for perfection. But if you see a price-to-sales over 50, stop. That is a bubble. And it has to pass the survival check, which is the cash runway. Valuation doesn't matter if the company goes bankrupt. Unprofitable companies survive on one thing: cash. Take their cash on hand and divide it by their annual loss. If they have more than 2 years of cash, they are safe. They can focus on growing. If they have less than 1 year of cash, danger. They will likely run out of money and be forced to issue new shares. That creates dilution, which crushes your stock price instantly. But where do you actually find these numbers without spending hours reading reports? For the Moat, I trust the pros at Morningstar. Search the ticker on their site. They literally give you a Moat rating: wide, narrow, or none. It's the gold standard. For everything else, personally, I use Finviz. It puts every metric we just discussed into one compact schedule at the bottom of the page. Also, Yahoo Finance to easily get total cash and free cash flow. Now, let's take some real-life examples. ARM Holdings, the architect of the chip industry. The Moat, wide. Almost every smartphone on Earth runs on their code. Competitors cannot easily switch. They are highly profitable. So we take path A. PEG ratio is 2.35. According to our rules, that is expensive. But remember, we said expensive can be justified by gross margin. ARM sells intellectual property. Their gross margins are an incredible 95%. This crushes our software elite hurdle of 70%. ARM is like a Ferrari. It is expensive, but the quality justifies the premium. It passes the gauntlet. Now, example 2. IONQ, a leader in quantum computing. You hear this name everywhere these days. We check Morningstar. The Moat is none. Strictly speaking, our roadmap says stop right here. They have great tech, but no durable fortress yet. Competitors could catch up. So we proceed with caution, keeping this in mind. They are burning cash to grow, so we switch to path B. Price to sales is currently 217 times sales. Remember our rule? Anything over 50 is a bubble. This is priced for absolute perfection. Warning light. Can they survive long enough to grow? We check the cash runway. Do the math. Total cash equals roughly 351 million. Free cash flow is negative 264 million. That gives them a runway of only 1.3 years. This is the danger zone. With less than 2 years of cash, they might be forced to raise money soon, which dilutes shareholders. This is a watch list stock. You love the tech, but the finances are tight. Now, do not forget to get your free copy of the roadmap. Link is in the description. Also, if you want to learn how to invest in AI, check out this video. Thank you for watching.